Today, we're going to discuss the 5 things that you want to consider when you're investing in real estate crowdfunding deals. Real estate crowdfunding deals, real estate limited partnerships, they're ubiquitous now. They are commonplace in the market. You hear everybody talking about them. There are deals everywhere now. There are a lot of real estate crowdfunding platforms. And while there's many deals in the market, not all deals are equal. Not all deals fit for you. Not all deals fit with your investment thesis. And not every deal is going to be a good one for you. They may be good for that sponsor because obviously they're doing that deal and they see something that's special in that deal, but it may not fit with what you're trying to accomplish. And so while one deal may be good for another sponsor, you really want to ensure that it's in line with your personal goals, with your investing goals. And so today we're going to talk about the 5 top things that I think are important when you're considering whether to invest in a real estate crowdfunding deal. The first one is understanding your big why. In real estate investing, as with everything else, you need to understand why you are doing this. You need to understand what your parameters are for a good investment. You need to understand what types of deals you like, what types of property types that you want to invest in, what geographic markets you want to invest in, how much money you're trying to get from a passive cash flow standpoint, because you need to understand why you're drawn to particular deals, but you also need to understand the rationale behind why you're doing everything. And so I really do believe that you need to understand your big why. A second thing that you need to do is consider the sponsor's business plan. Does the sponsor's business plan align with your investment thesis? That being, does the property match the property types that you want to invest in? Is the property in geographic markets that you want to invest in? Are the return metrics in line with what you were trying to accomplish from a return perspective? And are you also seeing that the hold period is going to be similar to what you want to do? These are all important factors that you need to look at. And so you need to look at the sponsor's business plan and compare that with your own investment thesis. The next thing you want to do is determine whether the investment is really going to provide you portfolio diversification by asset type, by geography, and or by sponsor. And so you need to know if you are 100% concentrated in the San Francisco Bay Area and you are looking for geographic diversification, if this deal is in the San Francisco Bay Area, it might not be the deal that you want to invest in. Likewise, if you are already 100% in multifamily investments, and right now your thesis is telling you that you should also be invested in industrial or service office or student housing or self-storage, then you need to make sure that the property that you're investing in aligns with what you are thinking. Don't just stick with one product type where you're going to be able to get no diversification. If the goal is diversification, you need to go for that diversification. The fourth thing that you want to look at is you need to determine whether the investment will provide you with the equity leverage and economies of scale that you could not achieve on your own. This is an important one, and this is why crowdfunding is extremely important. It's a valuable tool. It's a great tactic and strategy to have in your arsenal, because effectively crowdfunding deals should be getting you the diversification you want, but they should also be allowing you to leverage your equity. So if normally you're going to buy $1 million property on your own, that's going to cash flow, and now you're able to buy into a $10 million property, your percentage will be less, but you'll have the ability to diversify. Because if you're going to invest in $1 million property in commercial space, you're going to need $300,000 to invest. So if you have $300,000 to invest, why not spread that around into multiple deals, multiple geographic areas, and with multiple sponsors? And then that equity leverage not only gives you that diversification, but it gives you the economies of scale, because now maybe you're putting $25,000 or $50,000 into a deal. So let's say you have $300,000 to invest. Now you can do 6 deals at $50,000 each, and you've gotten a little bit of diversification. And meanwhile, you're also getting the economies of scale, because the larger deals generally have more profit potential. As prices go up, as cap rates drop, as price per square foot increases, as rents go up, you're able to achieve more cash flow and ultimately more profit from the sale of that asset. The last thing that you want to look at is understand the returns of each deal. Are they believable? Are they realistic? Are they achievable? And do they match what your goals are from a cash on cash basis, from an internal rate of return basis, and also on an equity multiple basis? And when you look at those 5 things, those are important aspects to look at whether to invest in a particular real estate crowdfunding deal. And so you really want to understand your big why. Consider the sponsor's business plan versus your investment thesis. Determine whether you're going to be getting the diversification by asset type, by geography, and by sponsor. Determine whether the investment's going to provide you with the equity leverage that you're looking for so that you can get economies of scale beyond what you could do on your own. And also understand the returns to make sure that the cash on cash, the IRR, and the equity multiple are in line with what you're hoping to achieve. On that note, I hope that you enjoyed this video today on real estate crowdfunding and the 5 things that you need to consider when investing in real estate crowdfunding deals. Till next time, let's continue growing our passive cash flow and net worth together.